right, for more on what's going on in the Aussie market at the moment, James Gerrish joining us from Shaw and Partners. He's also the author of Market Matters. James, it is an ugly day out there. What are you seeing?
It is indeed, Andrew. So you made mention of the Aussie market being down a couple of percent. There's only one stock in the ASX 200 that's trading higher today. So the lone wolf is computer shares, CPU. Domino's is trying to stick its nose in front, given a broker upgrade, but pretty much red across the board, mate, as your screen is showing in front of everyone.
All right. How would you sum up the reaction then to that inflation report? Is it an overreaction?
No, I think it's to be expected. So you think about the market's movements leading into the CPI print overnight. The market's been pretty strong over the last 4 sessions leading into it. There was this expectation that inflation had probably peaked, that we're going to see prices start to stabilise and track lower. The fact that it was month on month we were looking for a 0.1% decline and we got a 0.1% increase. I think that's talks to traders' positioning. So the market, I think, was expecting something with a 7 in front of it. We got something that had an 8 in front of it, plus it was a little bit more than expectation. So I think that the reaction is probably about right. I think what I'm looking at more intently is what next, and the bond markets, I think, are the key in terms of that. The US 10-year yield's now approaching 3.5%, which is its recent high. I think it'll be really interesting to see what happens then. I think I wouldn't be surprised to see the market pause at that point, and we see some consolidation in yields as they increase by 75 basis points. Even if they increase by a full 1 percentage point, I don't think now the market will be overly shocked by that if it was to eventuate.
All right. The big question, James, how you play this as an investor. Clearly, you want to be defensive in this current environment. How do you do that?
Yeah, each to their own. I mean, we get a lot of people like being defensive when volatility increases, and I thought I'd highlight a couple of stocks that would sort of favour that theme. I don't think it's all around what an investor is trying to achieve. So it's important to have a sort of a ballast of defensive positions in the portfolio that you sort of look at on days like this, and they're doing relatively well in terms of the broader market weakness. So, one stock we've written about this morning in Market Matters was Rural Funds Group. They're a large real estate, agricultural land, real estate company. They own the underlying land and lease that out. They've signed an interesting deal just recently or yesterday in terms of macadamia orchards, leasing about 3,000 hectares to an overseas company on a long 40-year lease with some very, what we thought were pretty attractive returns. So that to me is one of those defensive stocks that has pulled back in recent times. Solid earnings and fairly predictable earnings in the forecastable future, and that's underpinning a yield of about 4.5%. So that's one to look at, Andrew.
All right, another one you're looking at is Metcash. What are you finding attractive about that?
Yeah, not a new story here in Metcash. It's sort of one that we own and we've held for a while. They've held their AGM last week, I think it was, and they talked of easing supply chains. But the real the medium-term driver here is defensive earnings, but the composition of their earnings is changing a little bit, with hardware becoming a greater proportion of their earnings. So in 2020 it was something like 9% of their earnings. It's now up to about 13%. This is a stock that trades and growing quicker than the supermarket, so or their food business. So you think of Wesfarmers trades on 22 times, with Bunnings 50% of their earnings. Metcash trades on about 13 times, and their hardware business is becoming a greater proportion of their earnings, so the multiple should also re-rate. So we like Metcash around that 410 mark where it's trading at the moment, Andrew.
All right, what about the energy space, James? You're finding, given where those prices are going, how are you playing that?
Yeah, I think traditional energy, so oil, gas and coal, etc., is still pretty well supported. I think there's, you look at the coal market, it's been hugely supportive of the coal companies here because they're printing a lot of cash based on elevated pricing. I think that that trade in the very short term may have run its course. We're looking for more, I guess, interesting ways to play it. So AGL is a company we held in our income-focused portfolio a few months ago. We sold out of it. We've now just added it back into the portfolio. Obviously, a bid on the table at 8.25. It's now trading back to 7.09. I don't think that the rationale for that bid has changed. So it's all about the embedded value in their assets. So to me, you want to be playing in a market that's volatile, and if you're looking for defensive positions, you want to add a few stocks in the portfolio that have got their own narrative outside of what the broader equity market is doing. So that's how you try and insulate portfolio performance in these pretty volatile times.
Well, of course, AGL is both a generator and a retailer, but it comes with that political risk too.
Oh, there's a heap of risk in this company, but it comes down to, I guess, market positioning. So when it was trading around $5, no one wanted to hear about potentially looking at AGL as an investment, citing the value of their underlying assets. Now it's obviously recovered to trade nearly to $9, and there's been more corporate interest in it. I think that the only way forward for AGL is to I guess embrace what Mike Cannon-Brookes is putting on the table and the consortium that is underpinning that, and I think that'll be the way that it goes. And I think a deal will ultimately done to take this business off the ASX, take it private, restructure it, and generate value that way.